A red triangle is a relative low. When I see a red triangle, I scale in long positions at fractal swing lows. This is one of my ways to catch a bottom. The more filters used, the better the chances of catching the bottom without opening too many positions, but a higher chance of missing it out too. With instruments that pay dividends like CVE, the lower price gets, the more shares I can buy with the same amount. The dividend payout is just a bonus. The main trading strategy is compound investing. 1892 is 5-minute swing low. To track the fractal bear trailing stops that have been stopped out, I checked it off. To track fractal swing lows, I used color-coded horizontal solid lines. Fractal bear trailing stops move down over time and will trigger buy stops. As long as the daily is above price, it is on a bullish pullback relative to the weekly, which is bearish. That means, as long as the daily is above price, there is a chance to buy lower. The shorter interval bears will take profits first based on the fractal pecking order. The longer-term bears will hold longer because of two main things. One, a longer-term bear may be using a small position size and needs a wider range to make a profit. Two, a longer-term bear who is using higher leverage may be holding for a larger profit, which is greed. The two main emotions in trading are greed and fear. Fear is stronger than greed. There are many anchor points. Here, the Fibonacci tool has been anchored at the monthly bull trailing stop, which is a significant low, to a daily bear trailing stop, which is a significant high. As long as the daily is above price, both bulls and bears have a limit buy cover order that has a chance of getting a fill. When, not if, the daily bear trailing stop triggers, some bulls and bears may buy cover on market for fear of missing out. The crosses below price are marked down levels based on ATR spike multiples subtracted from a swing low. 1819 is 15-minute swing low. Next bear trailing stop in the fractal pecking order is the hourly. The easy way is to wait for a green triangle to sell. To front sell a green triangle and take earlier profits, patterns are used. One of my favorite patterns is the bullish wolf wave. The hourly bear trailing stop is next in line to get stopped out. Green triangle, relative high. Hourly bear stopped out. Watching bull trailing stops now. The shorter interval bulls will take profits first. 1976 is 5-minute swing high. Next bull trailing stop in the fractal pecking order to get stopped out is the 15-minute. Magic line, target made. Bullish wolf wave still in play. As long as the hourly is below price, it is on a bearish retrace relative to the 4-hour. A bearish retrace is bullish. That's with the annotations turned off. I also checked off the bull trailing stops that got triggered, so that it is easier to track the 15-minute bull trailing stop. Red triangle, new relative low, hourly on a bearish retrace relative to the 4-hour, 5-minute on a bullish retrace relative to the 15-minute. Hourly bull base, higher red triangle, which is a higher relative low. 1819 is the red triangle with an hourly swing low now. 1971 was the blue dashed line magic line bull target. 1976 is the green triangle 5-minute swing high. That's zoomed out to show that the daily is on a bullish pullback relative to the weekly and the monthly. One could wait and buy at 1819 and continue scaling in from there, or use profits to scale in again starting at the new red triangle, which is a new relative low. That is how I use markets money to build a long core, and it's not financial advice. Do your own due diligence.